So, before I kick it off, I would like to start with a little story which might help you to better understand why I believe this is a relevant topic today. If I remember it correctly, I think it was last year in July 23, 3 weeks before, I had written an article together with Michael and my partner, a guest article in the Börsenzeitung. And the article was primarily addressing the major underinvestment of German pension funds in European VC. The key message was that more than 80% of the profits of the German ecosystem finally go to US pensioners and Canadian firefighters. At that day in July, I was meeting with the CIO of a big German pension fund, and obviously I was very unsatisfied how this important investor group like pension funds and also asset manager are perceiving VC as an asset class in Germany. So I was asking the obvious question, why do pension funds not investing more into VC? Well, to make it short, his answer really caught me and made me think. Of course, he mentioned regulation, but more importantly, he was saying that one of the major factors is a language issue and a communication gap between, let's say, small cap venture capital and large cap asset managements. And that also VCs in Europe, and particularly in Germany, have to step up with a more investable product and a more adequate communication. Which brings me to our panel today, and the questions I'd like to ask my dear panelists are, first, which role can European banks, and we're in Frankfurt here, a lot of banks here, play in their capacity as advisors and also asset managers to support VC as an asset class and to democratize and institutionalize the asset class venture capital. And second, how can banks also benefit from it? So I'm honored to have an esteemed panel of experts joining us today. And first, I'd like to introduce Sebastian Becker, General Partner of Redalpine from Zurich, one of the largest VC funds in Europe. Second, Dr. Lorenz Jüngling, co-CEO and Managing Director of Moonfare, Berlin. Third, Hesham Sabra, Vice President of Investment Banking at Barclays, London. And finally, Massimo Soriano from Rothschild, Zurich. So, Massimo,
key points.
Thank you for coming. Rothschild Group operates in 3 divisions. So you have global advisory, you have wealth management, and you have also merchant banking, 5 areas. And in the past, we talked a lot about the kind of virtuous cycle of venture capital in banking. And my first question is to you. So can you just briefly describe what virtual cycle for VC in banking actually means for you and for Rothschild, and how much exposure Rothschild currently has into venture capital? And finally, also the question how you are planning to improve access to founders and entrepreneurs in Rothschild.
Thanks, Marcus, and great to be here. That's a big question. I'll try to break it down. Rothschild & Co. Group consists of 3 divisions, like you said, and I like to think about it in a flywheel. I'll do it from the perspective of the bank. We've got wealth management has a mandate for discretionary advisory mandates across continental Europe, and we support entrepreneurially minded investors as well in that journey. And so there's a bridge that was missing, and I spent some years on that these last couple of years in the form of matchmaking, where we connected in the early stage entrepreneurially minded smart capital investors with startups that we're not yet in the growth phase where, for example, our M&A advisors have a role to play. And so trying to build that bridge supports and gives access to the front, to interesting investors, as well as to founders. And hopefully, if you do it right, you have then a nice segue to the business in global advisory. Five Arrows plays an interesting role. When you talk about exposure formally to venture capital, we've got private equity, private debt vehicles, and increasingly some of the new strategies have a portion, an allocation of growth, venture growth in them as well. So I see Five Arrows in part as a product that I have in wealth management as part of my quiver, but also as an investor potentially for some cases.
Okay, thank you. So Hesham, I mean, you're representing Barclays as a fully integrated investment bank with three major priorities. I mean, first of all, you want to deliver on next-gen finance, interesting. Second, of course, sustainable growth in CIB. And third, also transition to low-carbon economy. And I understand that you have already invested approximately 100 million euros under sustainable impact capital, and that you're targeting 500 million euros by the end of 2027. So could you clarify kind of if you're using your own balance sheet money or your shareholder funds?
Both. Yeah.
Both.
It's an interesting question, Markus. Many thanks. And maybe let's start with reminding ourselves what banks actually are and what a bank actually does. So, as you have heard in the previous panel, we are a huge institution and we are massively regulated. So for us, we have to navigate through a lot of interests that are surrounding us. You have, for example, the main objective of a bank to accelerate growth in an economy and to invest into startups and growth companies and support the economy overall. And on the other hand, you have shareholder and stakeholder obligations that we face and the risk-return profile that we need to meet the demands of our investors and stakeholders as well. So if you think about that question, it's important to ask the questions, what are banks actually allowed to do in that whole environment, in that whole ecosystem, and what do banks actually want to do in that VC ecosystem? And it's not an easy question to answer, as you can imagine. So basically, what I've brought with me today are three ways on how banks can support and invest in the VC ecosystem. The first one is the most straightforward one, an easy one. It's just connecting investor A with VC fund B. Just leveraging our huge network that banks ultimately have and connecting those two market players. The second one is a typical bank business. It's the issuance, for example, of a margin loan, where the loan is secured by the underlying asset, i.e. the portfolio company of the VC fund. That's something that gets requested on a very regular basis, and we have to take a business decision on this one. And the third one, and I think that's the one where the engagement is really maximized in the VC space, the third one is the creation of an own investment vehicle. So in a platform where investors, our customers, can invest in, and we actually actively advise them to invest into that asset class. And that's always, if we advise someone to invest in an asset class as a bank, you always have to take into account regulation and also liability risk. So it's not an easy way to do it, but as you have outlined, it's a key cornerstone in the Barclays strategy. So we need to get engaged into the VC space if we want to accelerate growth in corporate investment banking. Why is that the case? It is the case because if we don't get close to the founders of VCs very, very early on, access to these guys gets impossible. So for us as an organization, it's hugely important to invest, to follow that strategy, also to reach our climate targets, obviously. I mean, that's the space that's most interesting. Lorenz, you know that, and Sebastian, you as well. So, I mean, at the end of the day, we have a clear commitment. We invest shareholder money, but we also allow investors and our clients with structurized products to go into the funds. The good news that I bring with me today is we do all three things. We connect investors, we issue loans, and we also have our own vehicle to support growth in the VC ecosystem.
But to sum it up, I think very similar to what Massimo was saying. I think there is a growing awareness in banks, merchant banks, that VC can play an important role for lead generation in investment banking, IPO advisory, M&A, but also on the wealth management side to attract, let's say, new AUM into the bank, right?
Exactly.
Yeah.
Exactly.
Okay. Lorenz, Moonfare has made significant strides in democratizing the asset class of private equity since inception 2016. So I've heard there was an announcement today, but maybe you can just share your journey and also your plans for 24.
Yes, I can. Moonfare was incepted in 2016. We did our first fundraise in 2018. It was actually still manual. We didn't even have a digital platform. At the time it was EQT, so it was private equity, as you said. We have since then raised funds for roughly 90 different GPs. A lot of them actually have been venture capital already, because that's part of what we discuss here. Actually, one of our biggest fundraisers was for venture capital GP.
Yes.
So that actually is a real cornerstone of what we do. We've done multiple different other strategies, impact investing, infra, private debt, secondaries, and we've recently also closed, it's a small amount, but for us it's a first step, 50 million on our first own fund, which is a co-investment fund, where we source the deals out of the co-investment deal flow that we obviously see because we have this large network of GPs. And thank you for mentioning that. It was actually yesterday we announced that we will launch an LTIF strategy soon in Europe, and especially also direct to consumers in Germany. And that's obviously something that's very exciting. Yesterday when we talked to the press, there was always this question, oh, you say democratizing private equity, but what does democratizing actually really mean? LTIF is the closest for us to get to that target. It's a real retail product. We can sell it to a larger group of people, and obviously minimums are lower. Still going to promise, based on historical data, promises. Obviously a difficult word, yeah, but like we're aiming at double-digit returns, and it's very well priced. So it's an important step for us in following our mission.
Okay. So, and your understanding is that you understand yourself as a partner of the VC and private equity industry, as a competitor, or how do you see yourself?
Look, we are definitely not a competitor of the VC environment or of the GPs. GPs do amazing things. That's not something that we would aspire to do. The fact that we use our network to also make direct deals or co-investment deals available is something where we invest alongside our partners, and obviously something that's really in a partnership spirit. Moonfare is two things in the end, or three things. It's a curated offering, so a lot of value comes from the fact that we do the vetting of the funds that come on the platform. That gives a little bit of security for the people who invest with us. It's a it's a tech platform in the end, so you can invest in 15 minutes if you would want to. I would never advise to do this, obviously, but technically it's possible. And it's also the largest high net worth and ultra high net worth community, because we have over 50,000 subscribers, 11,000 investments made to date. That's obviously a unique group of people that we started with, and yeah, these three things characterize us.
Okay, very cool. Thank you. So Sebastian, you're coming from Zurich.
Yes.
You're part of one of the largest VC firms here in Europe. You're based in Switzerland, Zurich. 23 was a challenging year for fundraising in particular. Nevertheless, you launched new funds. I mean, just tell me about your latest funds, and what I'm also interested in particular is also your investor base. So we're talking a lot about institutionalization of the asset class, venture capital. So how many pension funds do you have there, and what's your relationship to asset managers and banks? How important are they?
Sure. So thank you for having me. Pension funds, not enough, unfortunately.
Yes.
But a few. We have actually 400 LPs, which is not the 50,000 that you have, but I would say quite sizable. And these investor base consists of entrepreneurs, top executives, but also bigger institutionals as family offices, and also our friends of KfW sitting here in Frankfurt. I'm very happy to have them on board. And regarding fundraising, I would say 2023 was challenging for everyone due to numerous reasons, and we discovered different themes, and maybe to share two of these themes. One is institutionals had a over-allocation in private markets, because public stocks went down, so they stopped investing. And there are a bunch of people that actually stopped investing because they lost money in the last few years. And this is kind of counterintuitive, as now is like a really, really good time to invest because we think valuations are now very much more reasonable than the last few years. Yeah. So now is really like the time to invest. So it was kind of challenging. However, we have soon some exciting news to share, but not today.
Yeah. Anyways, look, I mean, I was opening the discussion today with my little story, with my discussion with a big pension fund, and I would assume you had similar experience, right? And maybe you can share also some experience when you talk to institutional investors and what we as VCs can improve, let's say.
Sure. So first of all, in the dream world, I would say that everyone that pays into a pension system should also get something of the cake, of the massive value creation that technology companies are creating in this world. But in Europe, we couldn't be more far away from this. So pension funds are not familiar with the topic. They're speaking a different language, as we also discussed before. And we also thought about maybe we should not call it even venture capital anymore, because venture is too much associated with risk. If we look, for example, into the US or Canada, there are some very great pension funds that are doing also great job in direct investments, like OTTP, for example, the Ontario's Teachers Fund is pretty good, and they have a professionalism where we are really far away. So what we need to do as VCs is do a lot of education, and more education, and more education, and but most importantly is build trust, and trust you build over relationships and performance over the years. So we really are in one boat here and need to push in the same direction.
It's interesting that you're mentioning the risk aspect in particular for German pension funds, because this morning I had a discussion, right? And we were trying to market funds in Middle East and US, etc. For example, in Middle East, I mean, you have to stress the return and the performance. They want to see the outliers. In Germany, it's completely, I mean, irrelevant. I
don't know if I would even talk about performance.
Yes, anyways. Cool. Massimo, virtuous cycle. I mean, you're spending a lot of time and effort now just to promote the whole idea of venture capital in the bank. And I would assume, I mean, you have a long heritage and well-established businesses, that there are some challenges, right? You spent some time in Frankfurt today with your dear colleagues here, just explaining what you're doing in Zurich. You're traveling to Paris, and you're really playing the whole company. So just maybe share a little bit what kind of challenges you have to bring things forward.
Sure, yeah. There's a couple different virtuous cycles. It's a recurring theme, as is education. And so at a grassroots level, one of the issues that I encounter a lot is venture capital as an asset class, great, super interested, want to learn more. But investors are very different in their preferences and how they approach it. Are they private business angels and only want to do direct deals? Do they look to co-invest alongside a fund? Not to mention corporates or even just pure VCs. And so one of the things that I'm beginning to do now, this year especially, is very much a focus internally, not even initially focused on clients, prospects in the community outward, but inward. And I could spend a lot of time networking internally. But in a nutshell, my focus this first half year is on creating a newsletter, creating office hours, sharing venture capital expertise with people like yourselves. You're welcome to come by and share on a specific topic, be it deal flow, be it portfolio construction, be it entrepreneurship. Because if you want to have a genuine impact and a relationship to a founder, you can't just show up at the time of the exit. You need to be a part of the story along the way. And again, you have to understand the role of the bank. So we're not going to necessarily be the seed stage investor, but if we can be a part of the story, help with network, and genuinely proactively use our network to help, then that's a valid contribution. Not to over-promise, but rather under-promise and over-deliver is kind of the approach. So education in the form of the newsletter, in the form of office hours, and finally taking my client advisors with me to the ecosystem, to events like this. Unfortunately, on short notice, I wasn't able to bring someone with me here, but that's the idea. And then these exposures, these touch points become real. and then it begins to grow outwardly. So that's the grassroots version, if you will, of that virtuous cycle.
You're mentioning newsletter. I think it's what's really important to really train your sales force, because they're not used to sell alternative investment products to their ultra high net worth individuals and so on, because they're selling other stuff to them usually, right? Is that correct?
It's not on our formal menu card, of course. So, or not of course, it is not. I'd love for that to be something in the future, but it's not today. And so we're responding and beginning to consolidate the network to know what is out there anyway. A lot of these, again, if you're talking about relationship now to private individuals, many of them are investing in venture capital, but they may not be doing it with us. And so as a client advisor, if you are genuinely interested in having a holistic understanding of your client and your prospect, rather than say, go do it over there, be a part of it, understand it, and try to proactively contribute to it, you have a much better chance of deepening that relationship.
Okay. Yeah. Hesham, I mean, you're also trying to improve access to entrepreneurs. You were mentioning access is really the most important thing, right? And like Massimo, I think you're also getting started. I mean, the fund is still relatively new. Maybe you also can share some challenges. Also, in particular, I could imagine that, I mean, it's a big bank, right? The communication between wealth management and CIB is not the kind of the typical channel, right, where you communicate, right?
Indeed, indeed. I mean, you have worked for a large bank as well and in the banking industry for a couple of years. You know how difficult it is to get someone convinced from a business that is not typical in a spectrum where banks operate in. I would like to give you two examples on challenges that we face if we think about investing or engaging in the VC space. The first example is around that margin loan that I have outlined in my first response. The margin loan discussion we have been approached by well-known VC funds a couple of weeks ago, let's say for a loan of the size of 100 million euros. Yeah? The loan would be secured by 1 billion of investments or portfolio companies that are worth 1 billion, at least the stake is worth 1 billion. And then we're starting to have the discussion around that potential loan. Does it work from a risk-return profile? Is this something that would fit into our loan portfolio? And interestingly, it would fit very well if it's properly priced. Yes. It fits very well in our risk-return portfolio. However, there is one thing that adds complexity to the whole loan. It's the fact that the asset itself, the underlying asset that the loan is secured with, is illiquid. Yeah? So that lack of liquidity creates something that we are not used to. And everyone in the organization is immediately, let's wait. That's a bit complex for what we usually do. There are ways around it. If it adds more complexity, it adds more risk, and therefore it requires further returns. Now, we don't want to make the loan unattractive for the VC from a margin perspective. So another way would be to think about future potential business opportunities that this loan could create. And if we grant now a loan to you guys, and you connect us, for example, to founders, and we can expect some future revenues out of it in the future, let's say IPO, sell downs, whatever it is, nobody knows at this stage, but this is how we would build our business case around. So we would look at M&A, DCM, ECM, and think about ways to increase our return profile on that loan. But that's a challenge we're facing, because ultimately this is a business decision. As you can imagine, it's impossible to quantify potential future fees or income of those free products for an asset that is sizable in 5, 6, 7 years. So that's one major challenge we are facing, and I will not tell you if we have approved the loan or not. That remains my secret. The second example that I want to give you is one around the vehicle that we have created, where we allow our investors also to invest in it and we advertise it. I mean, it's structured in a way that fits the banking system. Yeah? Yes. I told you before, we are regulated. We have reputational risks. We have litigation risks. So at the end of the day, we need to make sure that if we advise the client to invest in this product, it needs to have the Barclays quality stamp on it. We need to stand behind that. So we need to perform our due diligence on the assets that are in this portfolio. So that's what our wealth management also does. So it's a bit different from just offering the digital platform and allowing them to invest into VCs. We make sure that the investors are well aware of the assets that are in there and that the assets have our quality stamp. But that's a challenge that we're facing as well, because
what is really interesting, I think, is the fact that, I mean, first of all, you're deploying your own equity.
Yeah.
But you've realized that you have to leverage yourself. It's too expensive, right? You do it because you want to brand it. It's your own thing. But at the same time, you leverage through external investors, right? And this, I think that's a very smart way of doing it. And I would assume that you're also using the access you have through your own funds to the portfolio companies to fuel your advisory business.
Yeah, exactly.
Yeah.
I mean, there's no way around. At the
Yeah.
end of the day, once such businesses gets too sizable, we don't get the access to them. So it's it's a key revenue stream for us.
Yeah. And I think what's also important is that it's kind of the market of corporate control, because you as a bank, you give some security for investors. It's kind of a due diligence stamp, let's say, which at the end of the day might also help institutional investors to invest more into this asset class, right?
Exactly. I mean, institutional investors is a topic for itself, I would say. I mean, banks can help to structure products in a way that suits institutional investors. But ultimately, I think there needs to be a change in the mindset of the institutional investors as well, to view this asset class as a very attractive asset class through the cycle from a risk-return perspective, which it is. Yeah. So it's about us. It's good that we're discussing this today, because ultimately we need to raise that awareness.
So, Lorenz, you're in a certain way also an intermediary, right? Like,
yes.
Like banks. Banks sell through their wealth management department. You do it directly, right? You're not using banks, or not? Or you did it, you tried it, or how did you?
It's like it's a yes or no answer.
Yes.
So, look, we are a new company, so there was an original idea. The original idea of Steffen, who founded the company, was that when he left KKR, he could no longer continue to invest into KKR, and he wanted to do so. So he tried to find some friends that would do it with him, and then he quickly learned that if you try to find friends who invest together with you in a fund, there's a regulatory problem to solve. So we solved that. We did our first fundraisers, and that's still where we originally, from our DNA, come from. It's direct to consumer, it's ultra high net worth and high net worth individuals. It's an original group of people that then obviously by word of mouth at the beginning became much bigger. And we did a couple of fundraisers, and then we were off to the races. We have worked and still do work with selected partners that white label our fund offering. We've talked a little bit about a couple of problems that banks have in selling alternative asset products. It's not something that they normally do, so it's something where we also need to provide a lot of guidance, need to provide some training. Still to date, I would say 80% of what we do is direct to consumer, that we do directly through our platform. The banking or intermediary channel is obviously interesting for us. Also the same is institutional investors, which we would actually bucket under direct to consumer. Some of our investors actually really are not the regular retail customer. It definitely is something that we continue to work on, but not necessarily something that has taken over from the original side of the business at the moment, and also we don't foresee that to change.
So focus still B2C, right? But you would not ignore institutional investors if they are willing to
Obviously,
invest.
there's a lot to learn and a lot to experiment in that channel, and especially with the LTIF that we talked about before. That's a pure fund product that we can also easier sell through partners, because that's also something that they're used to. So that's obviously something where we will go more in that direction.
Cool. Sebastian, I mean, during our discussion, and I know that, I mean, you're selling through banks, right? So you have teamed up recently with banking partners, wealth management platforms, let's say, and it's kind of a win-win situation. So, I mean, I would assume they need a product, right, which you have, and you can benefit from their distribution power. Is that right? And how does it work out with these guys?
Yeah, exactly. So first of all, our fund landscape is a bit fragmented. So we have classical closed and early stage funds where we invest in startups. And now we have a new product, which is an evergreen fund. Open-ended, And this evergreen fund invests alongside all the strategies of the company. And with this product, we went to banks, and the banks were had open ears because it solves some problems for them. It solves first the problem that you not need 1 million francs, because normally you need 1 million francs to invest in our funds to access it. So much lower entry barrier. And the second big problem that banks face is liquidity. So we made it semi-liquid. In our early stage funds, you are 10 years plus locked in. And within our evergreen fund, you have yearly liquidity. And this is very compelling. Yeah? And the last thing is that is super compelling, that with venture capital, you invest in innovation and people working on the big problems to make the world better. And this fits very good to entrepreneurial customers, to the next generation. And therefore, we closed some selected partners in Switzerland that provide this product in their wealth management division.
Yeah, I mean, we had an interesting discussion, and the thing is that the market for wealth management is extremely fragmented and highly competitive here in Germany and Europe in particular, right? And it's really hard to get a new mandate. Let's say if you're working for Pictet and you want something, a 60-year-old to move from UBS to Pictet, it's a tough sell.
Definitely.
Yeah, and I think the only chance really to attract new AUM to your bank is actually the next gen. I mean, either they're the heirs, 35-year-olds, or they're new founders, right? And interestingly, the asset allocation of this next gen is completely different than the fathers and the grandfathers. So they have 30%, 40% in sometimes in alternative assets, and not like their fathers and grandfathers, 5%, right?
Definitely. But it's not a walk in the park.
Yes.
So you don't close the partnership and then the money is flowing in. So you need to really work with the banks, do education, train the relationship managers. And it's the extra effort that we are going, and let's see where it heads to. At the moment, the product is already over 100 million francs, so some people like it.
Okay. So Massimo, I mean, you have all these ultra high net worth individuals, and then they just want to play around and say, look, let me invest into this startup A, B, and C. Show me some deal flow. Yes, and how do you react? I mean, do you think it's a good thing that they invest directly into startups, or you rather recommend to have a more modest approach and first invest into a VC fund? I mean, how do you handle this?
No, it's something I've worked on for a while, and I like listening to and hearing that other actors are beginning to see the need also to be a part of this education component. The last couple of months, I've sort of come up with the mantra, there's no one-size-fits-all to venture capital. And a lot of investors, and I've encountered them more in sort of the private investor family office space, they're excited for reasons already mentioned, high potential returns, being part of the next big thing, but also really making an impact on society. But I think one of the roles, again, as a bank is to not put on the brakes for the sake of putting on the brakes, but to say, okay, my goal is, if I really care about you as an individual and the way you're investing, to make you the best investor that you can possibly be. Because the last thing you want is a private investor to start investing in venture capital without a plan, with not enough time, and have no fun after 1 year and give up the whole strategy to begin with. So it's really, and this is part of my sort of community approach, is taking the time to understand and take investors with us to events, to put them in touch with the right partners, to not just show them one fund, as much as Redalpine might like me to show that fund, and I'm happy to, but also to show some others and really give comparisons and make sure that those differences are known.
Yeah.
Direct and indirect is a whole other can of worms, right? Matchmaking is high risk, and direct investing is riskier. I think that is something that we have on hold for the moment. If you're doing it properly, the way you do in private equity, that's fine. So there is an implicit nudging potentially towards funds as a way to better capture the asset class and be diversified. But again, that's now getting into the next piece of the discussion, which is what is the infrastructure and how do you make that available?
Cool. Hesham, I mean, you're a tech banker by education, right? And I mean, a more general question, I mean, what is the state of we see a tech in Europe these days, and maybe you also can quickly comment on the lack of institutional investors also and how it affects your banking business, in particular here in Europe.
Yeah, I mean, obviously the market is not where it was a couple of years ago, unfortunately. Yeah? So capital becomes or has become much more expensive, much less accessible, I would say. And what I think is really important here is that we raise the awareness that for Europe as a whole, it is tremendously important that we support our founders, our entrepreneurs, the risk takers, I would say, in this whole economy to succeed. Because otherwise, Europe as a whole will not work against, or will lose the competition, the competitive process, I would say, against the US or Asia. So we face an issue here, and what we see is that we as institutions, we as banks, the digital platforms, the VC funds, they need to show trust in the founders and the entrepreneurs. And I think that's something that we see. The market has become more difficult. It is on us to further support growth in Europe and further accelerate that growth of those companies we believe in. You mentioned the lack of institutional investors. Certainly, this is one way to help founders and entrepreneurs to get easier access to money. I think it should be a key cornerstone in our future strategy if we think about opening that asset class up. The only problem is with that, I mean, obviously, we as a bank can create a product that works for every investor. However, sometimes the regulations within those institutions, within these pension funds, within these insurance companies, they just don't allow them to invest in such asset classes. So then we're again at Sebastian's point, education, education, education. Without getting that mindset right of those market participants, we will not get them to invest into that asset class, even if it fits their portfolio in a very, very good way, because it's a very, very strong and stable through the cycle return that you can achieve, and it's not that risky if you look at it through the cycle.
Yes, definitely. So Lorenz, you just launched a new fund. It's an LTIF.
Yes.
Right? And it's quite innovative. It's new. Yes. Right? And it's open, closed, yeah?
It's a closed-ended fund.
Closed. And how do you do your fund selection, actually? I mean, how does it work? I mean,
sure. So LTIF in itself has been around since 2015.
Yes.
Unfortunately, the regulation about LTIF, which is a European long-term investment fund, in their first inception wasn't really suitable. So it didn't take off. I think there was probably roughly 20 LTIFs that actually ever got conceived. This year there is a new version of that regulation, LTIF 2.0, which actually allows for a couple of things that make this an attractive product. Why do we do an LTIF and what makes it different is, number one, it's a product that focuses entirely on private equity and venture capital, so all of the products that we currently have on our platform. It will be a combination of fund investments and co-investments, so from the fund side we will get a faster diversification while the co-investments still keep it interesting. It's something that gets the same quality of product and the same fund selection process that we have for our original product that was direct to the GP investments. So we say, if you come and say, I have 10 million, then we will craft your own portfolio, walk with you through different investments. If you come and only have 10K to invest, you will essentially get the same thing. We will just have to do these things with you and for you in the structure of the LTIF. There's one final thing that makes our LTIF different. LTIF is obviously, because it's retail focused, something that needs to provide liquidity. We've talked about that. Retail investors expect a way out. They don't want to be locked in for 10 years, even if it's a closed-ended fund. We have already in the past been operating a secondary market where we put buyers and sellers in touch of the original GP stakes that we had. This will also be available for the LTIF, so there will be twice a year or 4 times a year, depends a little bit on the demand, a liquidity window where people can trade their stake. And that's something that we feel, together with the quality of the product that goes into the LTIF, makes this, although it's a retail product, really something that's outstanding. And it's also the one product that we aim at intermediaries at banks as partners to sell, because it's easier to sell, It's more targeted at a broader mass affluent audience, and it's a standard UCITS fund, so it can be easily booked.
Wonderful. So, Corinna, you're looking at me for the benefit of time. One quickie, the last one, yes? So, maybe to all of you,
Yes.
same question, right? So, intermediaries. So what would you expect from intermediaries like banks, investors, regulator, the next 2 to 3 years to improve funding, VC funding in Europe? I mean,
Yes.
some ideas?
Okay. So what I would really wish for and what we all should push for is that the performance of pension funds and the asset allocation comes on the agenda of the media, because this is really bad. So that is something we should really push for. And when I could wish for something from the regulator, we should look at our neighbors, beautiful Switzerland, because they launched a new regulation, because in the past, venture capital was in the bucket of alternative investments, 15% capped, and now they launched a new bucket, 5% on top of the 15, which is great, because every pension fund manager in Switzerland, and there are a lot, is now looking into this, yeah, and what does it mean for us? Should we do it? Should we not do it? And it's a great step in the right direction.
I will make it brief. There, private markets should be in every portfolio. There was a time 100 years ago when public markets were also exclusive. Private markets will go the same way. We will all be investing it at some point in time. You can choose when you want to be part of this.
Yeah, we need to continue to support our clients to invest into this asset class. We need to raise awareness, and this is clearly something we have on our agenda for the future.
Yeah, I think for me it's about figuring out a way to invest responsibly in the asset class, but also to change the window, because you can't put the cart before the horse. To change the optics from here, dear startup, dear investor, we have hundreds and thousands of clients waiting to invest in venture capital. That's not the case today. We don't even have the infrastructure there for it. So rather figure out ways to chip away at that and educate along the way, be part of the infrastructure so that this dream ends up becoming reality.
Wonderful. So thank you very much. I mean, there's one final quote from Ulrich from IVE, and this is something which really kept in my mind, and he was saying that venture capital is the best macro hedge for your entire portfolio, which is true, right? If there is no innovation, there is nothing in the next 10 years. And so thank you very much.